Hey everybody, just want to give you a quick update on kind of what we're seeing in the market, state of the market, different dynamics. There's been a lot happening here in 2025, from tariffs to interest rates not cutting as fast as people thought they possibly would, supply starting to fall. So just thought we would do like a quick update on what we're seeing in the market. In regard to tariffs, I can kind of tell you that we've really tried to be proactive in managing these tariffs by diversifying our supply chain. We actually have two primary suppliers at Rise48. One of them is producing most of their materials here domestically in the United States. Really helps us to mitigate the effects of that. We actually met with them in Q3 of last year, 2024, just to kind of see what are they going to do to, help mitigate any potential risks of tariffs. We have our domestic supplier, which really helps us, and then we have another primary supplier who is sourcing most of their materials from Vietnam and from China. What they did is they actually built up a big stockpile of materials for us prior to the tariffs really kicking in anticipation of this. And obviously the tariffs have been impacting, virtually every business industry in the United States, but we feel pretty good with our supply chain in that regard. So we'll see how that kind of shakes out. Obviously, when these tariffs were initially, being announced and they were very extreme at first, there was a big shock to capital markets, 10-year treasuries fluctuating significantly, stock market fluctuating. At the time of this recording, and I say that because it is so volatile, it could change by the time this is posted, but at the time of this recording, first week of June, things have stabilized at this point in time. Most recent job data that has come out is showing that the economy may be softening a bit. Jerome Powell, with the Fed chair, has said that they are watching the data closely. There are no interest rate cuts imminent at this time. And so, the first couple of years, 22, 23, we were more optimistic that, the interest rates would be cut at some point, sooner. But now it's been over 3 years. We haven't seen a whole lot of relief, with the first cut coming in September of 2024, the first cut in several years. And so we don't see much changing the rest of the year here in 2025 with interest rates. There is still a window here of buying opportunities, which is prolonged. And so there are still distressed deals out there that have loan maturities coming up. We've been buying deals where sellers are having to sell at a significant loss to pay off their loan. So it does extend that horizon or that window of opportunity because there's not a lot of interest rate relief. Now, the biggest thing that's going to drive values and increase transaction activity in the next 24 to 36 months is the supply of new apartments that is being absorbed in the major Sunbelt growth markets throughout the country. Now, we are focused right now on Phoenix, Arizona, Dallas, Fort Worth, Texas, and then North Carolina, primarily, Charlotte, Greensboro, Raleigh, Durham area. In those markets, when you're looking at the supply pipeline, it's supposed to start declining second half of this year and then really fall off in 2026 with significantly less deliveries. And the good thing about these three primary markets that we're in is that you still have really strong in-migration and population growth of people moving into those markets. A ton of jobs and companies are still moving there. So you've still got that same demand for people to move there, but you're gonna have significantly less housing. That's actually gonna be a shortage of housing the next 24 to 36 months, which will help to really give us more of an advantage as investors and owners of these properties. Because I can tell you in Phoenix, for example, the last couple of years, there's actually been negative organic rent growth in the Phoenix market in 2023 and 2024 for the first time in over a decade. And the biggest reason for that was because of all the new supply of housing that hit the market all at once. But as that falls off, if you look at like CoStar projections and things like that, they are projecting positive organic rent growth the next few years in these major growth Sunbelt markets. And so we think now is a good time to be acquiring new assets if you can find them. They're really hard to find where they make sense. But I can tell you, we haven't really seen cap rates change much in the last 12 to 18 months or so. And so it's not necessarily like you're getting cheaper prices now than you were 12 months ago. It's if you can find a deal where a seller kind of has to sell. And so the common theme for us is either they do have a loan maturity coming, they have to sell to pay off the loan, or maybe they've owned it for 15 to 25 years, they have a very low basis, and now it just makes sense for them to cash out. So those deals are really hard to come by, but we do think that you'll start to see transaction activity pick up the next 6 to 12 months, which will really be driven by supply getting absorbed and falling off. Because remember, there's been little to no new building of apartments in these major growth markets since the second half of 2022 after interest rates had skyrocketed, okay? Because those interest rates blew up a lot of those construction loans, And so it typically takes at least 2 to 3 years for these apartment buildings to be delivered from when they're starting to be built. And so now, since nothing's really been built, 23, 24, you have this dry pipeline, and the residual impact will be is that there will be a shortage of housing. And so that's going to help burn off the concessions that you've been seeing in a lot of these major markets the next 2 to 3 years. It will help to increase the organic rent growth, which will then obviously just help to increase transaction activity. So we do think now is a good time, to buy these assets with where we're at in the market cycle. I'm not going to pretend to give projections on interest rates because who knows what will happen, but I think the most recent data, is showing that the PCE inflation is down, beyond what people projected. The recent ADP jobs report, came in much softer than what people had thought it would be. So there are some signs of softening, which, hopefully for us as real estate investors leads to some interest rate relief in the second half of 2025 here. That's kind of what we're seeing right now. We think now is a good time to buy if you can find good deals. We're really focused on making sure we're pre-qualifying residents as far as income checks, credit checks, background, things like that. And so it's just about really focusing on operations for the rest of the year and dialing in these assets. So if you'd like to learn about how you can participate and invest in future opportunities with us at Rise48, then set up a call with us at the link below. You can set up a call with our team. We'd love to speak with you soon, and we'll talk to you soon. Thank you.